When I see people talk about taxes online, most of the debate feels purely emotional. It's usually reduced to extremes. Either tax is theft or tax is absolutely necessary. Both sides miss what actually matters. Taxes aren't a moral question. They're economic architecture, the mechanism through which a country converts private productivity into public capacity. They're also how a country encodes its priorities, what it wants to encourage, what it wants to slow down, and what it's willing to subsidize. The same tax rate can feel completely different depending on what you get in return. In some places, taxes translate into healthcare, education, infrastructure, safety, and long-term security. In other places, not so much. And that difference changes how people experience the system. Let's understand how the machine works. The United States has one of the most interesting tax systems to analyze, not because it's simple, but because it's incredibly engineered. On the surface, it looks straightforward, a progressive structure with marginal brackets. Your income is split into layers, and each layer is taxed at a different rate. The rates step up gradually, starting low and going all the way up to 37% at the top. But most people focus too much on the brackets and not enough on what actually gets taxed. In practice, your gross salary is almost irrelevant. What really matters is how you move from gross income to taxable income. And that path is filled with deductions, exclusions, credits, and timing choices. Standard deduction versus itemized deductions, pre-tax retirement contributions, health savings accounts, business expenses, depreciation. All of these reshape what the tax base even is. The U.S. tax code isn't just a way to collect money, it's a way to shape behavior. The government doesn't simply take a percentage and walk away, it actively nudges people towards certain actions. Save for retirement, you're rewarded. Take on leverage for housing, historically you were rewarded. Invest through businesses, you get depreciation benefits. This is how the system quietly channels money into capital markets, housing, and long-term investment. The complexity isn't accidental. Complexity creates optionality, and optionality creates advantage for people who understand the system or can afford advisors. Tax planning itself becomes a form of financial leverage. Then there's another layer. The U.S. isn't really one tax system, it's 50-plus systems stacked on top of each other. Federal tax is just the starting point. State income taxes vary wildly. Some states charge nothing, others charge aggressively. Two people earning the same salary in the same federal bracket can end up with very different take-home income, depending purely on geography. In the U.S., strategy matters almost as much as income. Where you live, how you earn, how you structure your compensation, all of that changes your real tax burden. When it comes to redistribution, the U.S. takes a mixed approach. Some redistribution happens directly through programs like Social Security and Medicare, which are largely funded via payroll taxes. Some happens indirectly through tax credits and targeted benefits. But compared to countries like Japan, the U.S. still expects individuals to shoulder significant private responsibility: healthcare choices, retirement planning, education funding. The U.S. tax system isn't simply high tax or low tax. It's growth-first capitalism with controlled redistribution, where incentives are embedded deep inside the rules, and understanding the system itself is a financial asset. Here at Easy Finance, we turn financial anxiety into financial confidence one video at a time. So if that sounds good to you, hit subscribe and let's learn together. China's system is progressive, just like the U.S. What makes it different is why and how that progressivity is implemented. On paper, China's income tax rates look familiar. They start low and go all the way up to 45% at the top. But the similarity ends there. The real distinction is in the mechanics. China's system is built around control, predictability, and enforcement, not individual optimization. One of the biggest structural differences is how heavily China relies on withholding and monthly taxation, especially for salaried employees. Most people never actively decide to pay tax. It's deducted before the money ever becomes usable. If your goal is high compliance, employer-based withholding is one of the most efficient tools available. It removes choice from the equation. China's deductions are particularly interesting. They're not just financial relief measures, they're policy signals. Deductions tied to education, housing, or family responsibilities tell you exactly what the state wants to encourage. China doesn't treat the tax system as a neutral revenue machine. It treats it as a policy instrument. A deduction here is basically a subsidy delivered quietly through the tax code instead of a direct government payout. China's tax system is designed to maximize macro-level stability, not individual flexibility. High compliance ensures predictable revenue. Monthly collections smooths cash flow, and policy-driven deductions allow the government to fine-tune behavior without constantly rewriting laws. Redistribution in China also works differently. Instead of focusing primarily on direct transfers back to individuals, the state channels resources into infrastructure, industrial development, and public systems, often with strong regional planning. The relationship between the citizen and taxes isn't "I pay, therefore I receive." It's more like the state structures the system, and taxation is one of the tools it uses. When people ask whether China is a high-tax country, that question misses the point. The more relevant question is, how much control does the state maintain over income flows, and how effectively can it enforce that control? On that front, China is extremely strong, not because of aggressive rates, but because of how tightly the system is embedded into the structure of employment and economic planning. Japan operates as a high-trust, high-service tax model. Yes, Japan has high taxes, there's no point pretending otherwise. National income tax rises progressively up to the mid-40% range, and then on top of that, there's a local inhabitant tax that's roughly flat across income levels. For high earners, the combined burden can feel heavy. But Japan isn't taxing people randomly. It's taxing to fund a society facing one of the hardest demographic problems in the world, a rapidly aging population. Healthcare, pensions, elder care, local public services, these things don't scale cheaply, and Japan chose to fund them collectively rather than pushing the risk entirely onto individuals. The system is remarkably predictable. Administration is formal, structured, and rule-based. Even the way local taxes are calculated, often based on prior year income, creates stability for municipal budgets and long-term planning. There's very little improvisation, and that predictability matters more than people realize. Japan isn't high tax, therefore unattractive. It's higher tax, lower uncertainty. And uncertainty is a hidden tax that people underestimate. If you live in a system where healthcare costs can bankrupt you or retirement security is fragile, you're paying for that privately through insurance premiums, precautionary savings, and constant risk management. The Japanese model is simple but demanding. Collect more, but also deliver more, and deliver it consistently. High taxes only work when people believe the public side of the bargain actually functions. In Japan, that credibility is the foundation of the system. The UAE is one of the clearest examples of tax policy as strategy. The UAE has no personal income tax, no brackets, no filing in the traditional sense, no direct taxation of wages. A lot of people hear that and assume it's generosity, but it's a deliberate economic design choice. By removing income tax, the UAE dramatically increases take-home pay, which makes it extremely attractive to global talent, professionals, entrepreneurs, consultants, investors. And once those people arrive, they create economic activity, spending, businesses, trade, services. The government then earns revenue through other channels, consumption taxes like VAT, corporate taxes, and revenues tied to commerce, logistics, and energy. Structurally, the UAE shifts the tax burden away from income and towards spending and enterprise. When you tax consumption, the government earns when money circulates. When you tax businesses above certain thresholds, the government earns from profitability rather than wages. But this model also changes the social contract. Redistribution works differently here. The state invests heavily in infrastructure, safety, and large-scale public projects. But many services, especially for expats, remain market-based. Healthcare, education, retirement planning often sit with the individual. The trade-off is clear. You keep more of your income, but you're expected to manage your own long-term financial security much more actively than you would in a country like Japan. The UAE operates as a growth and attraction tax model, designed to pull in human capital and monetize economic activity through business and consumption rather than wages. Singapore's tax policy feels like precision engineering. Yes, Singapore's personal income tax rates are low by global standards, topping out in the low 20% range for high earners. But the real strength isn't the headline rate, it's the structure. Singapore is obsessively clear about rules. Tax residency matters. The distinction between residents and non-residents is sharp. Compliance is strict but fair. Administration is efficient. You don't feel like you're guessing what the system will do next year. Singapore also treats investment income strategically. The system is intentionally designed to stay globally competitive for finance, entrepreneurship, and capital formation. The message is clear. Productive capital is welcome, but it must operate within transparent rules. When it comes to redistribution, Singapore doesn't behave like a large European welfare state. It follows a targeted support plus personal responsibility model. Instead of very high taxes funding broad universal benefits, Singapore keeps taxes moderate and delivers support through carefully designed schemes, subsidies, and policy instruments that are tightly administered. Singapore's real pitch isn't low tax, it's predictability. You'll pay tax, but the rules won't change arbitrarily. Corruption is low, enforcement is consistent, and the business environment is stable. Singapore operates as a model of low tax credibility. People don't mind paying taxes when the system is simple, the enforcement is fair, and the outcomes are reliable. Singapore operates as a model of low tax credibility. Hong Kong is one of the clearest examples of tax philosophy being expressed directly through mechanics. Hong Kong taxes employment income under what's called salaries tax, but the interesting part isn't the name, it's how the tax is calculated. The system literally runs two calculations. One uses progressive rates that top out at a relatively low level. The other uses a flat-style standard rate, and then the government applies whichever result is lower for the taxpayer. That's not accidental. That's an ideological statement built into math. The system is essentially saying, we will collect tax, but we will do it in the least distortive way possible. It's a deliberate pro-efficiency, pro-competitiveness design choice. The tax base is also notably narrow and controlled. Income is typically assessed after deductions and allowances, and the rates themselves are low by global standards. But the deeper reason this works is historical. Hong Kong never tried to fund itself primarily through high direct taxes. Instead, it relied heavily on land-related revenues and asset-based income, which allowed it to keep personal income taxes low while still funding public goods. That decision shaped Hong Kong's identity. Low direct taxes made it attractive to business, finance, and global talent. And once that ecosystem formed, the tax system reinforced it rather than fighting it. Redistribution in Hong Kong is relatively limited compared to high-tax welfare states. The government doesn't attempt large-scale income redistribution through the tax code. Instead, it focuses on keeping the economic engine competitive and funding public services through a different mix of revenue streams. The trade-off is obvious. When property markets fluctuate or land revenues come under pressure, fiscal debates become intense because the entire system is built around the idea of low direct taxation. Hong Kong operates as a minimalist taxation supported by strategic revenue architecture. It's not trying to be everything to everyone. It's trying to remain efficient, competitive, and globally relevant as a financial center, and the tax system is tightly aligned with that goal. This is where most surface-level discussions about tax completely fall apart. A tax rate is just a number. A tax system is an entire machine. That machine decides what even counts as income and what doesn't. It decides which deductions exist, how easy it is to avoid or defer tax, whether enforcement happens automatically or relies on voluntary compliance, whether income is taxed monthly or annually, how capital gains are treated, whether Social Security is funded separately through payroll taxes, and whether ordinary people can actually understand what's happening. That's why two countries can have similar top tax rates and feel completely different to live in. In the United States, taxes are deeply intertwined with incentives and complexity, and planning matters almost as much as income. In China, taxation is tightly integrated with compliance and state policy steering. In Japan, taxes are high, but they're tied to stability, predictability, and long-term social continuity. In the UAE, low income tax is a deliberate global talent strategy funded through consumption and business activity. In Singapore, moderate progressive taxes combined with strong governance create predictability and competitiveness. And in Hong Kong, the system literally chooses the lower tax calculation for you, which tells you everything about its pro-business identity. It's not the question whether a country is high tax or low tax. The question is whether the system makes sense. Does the tax structure match the country's economic model? Does it collect revenue efficiently? Does it reward the behavior it claims to value? And does it deliver something visible and credible in return? Because a low tax system without strong institutions eventually feels fragile, and a high tax system without trust eventually feels oppressive. What actually works and what lasts is coherence. Once you understand that, taxes stop feeling like a mystery or a punishment. They start to look like signals. Signals about how a country thinks, what it prioritizes, and what kind of future it's trying to build. This understanding is incredibly powerful because money flows towards systems that are predictable, credible, and internally consistent, not necessarily the ones with the lowest headline rates. If there's one thing you take away from this video, it's this. Taxes aren't just numbers, they're architecture. And once you learn to read that architecture, you start seeing countries very differently. If you found this way of thinking useful, subscribe to the channel. And I'm genuinely curious, if you had to choose one of these tax systems to live under, which one would you pick and why? I'll see you in the next one.